The survey results make it abundantly clear that credit union members do view credit unions differently. Credit union members that use credit unions to finance are saving in excess of $10,000 over the life of a 6-year car loan. Hi, and welcome to the March 2024 version of America's Credit Unions Economic Update, our monthly video review of economic developments and financial market trends that matter to your credit union. I'm America's Credit Unions Chief Economist Mike Schenk, and for this month, I want to not talk about the Federal Reserve, not talk about things like consumer confidence or the lack thereof, and spending and that sort of thing. What I want to talk about is credit union impact and update you on some of the ways that we've refreshed data that you can bring to the table in your conversations with policymakers as you advocate for your credit union and credit union members. Specifically, what I want to do is let you know that we've updated a survey that we've now done for 3 years. Actually, I should correct that. We've been doing this survey for about 20 years. In the past 3 years, I've put some questions into the survey, that long-run survey, around credit union mission and impact, and essentially whether or not credit unions are viewed by their members differently than banks and other institutions are viewed by the customers that they serve. If you've seen me talk about this in the past, you know that I get pretty excited about it. You know that in the past there have been differences that we've seen, and I have to say that those differences are really, really significant. They have been historically, and they are in the current data set as well. So just to give you a line of sight into what we're up to here, we're now calling this survey the Consumer Pulse Survey. Historically, it was the Voter Survey. It's the Consumer Pulse Survey. It's an online panel conducted by Frederick Polls in February of this year. So this is fresh data. We have a nationally representative sample of 2,500 voters. The margin of error in our survey results is plus or minus 2%. We focus on differences between credit union members and non-members. So this is not a credit union versus bank analysis. This is simply an exploration of how people that use credit unions think about those institutions and how those points of view differ from what other people have, whether they do business with banks or other financial providers, mutual fund companies, brokerage firms, or non-traditional providers of financial services. Our questions actually focus on financial behaviors and outcomes, trustworthiness, and connections to the local community, and they're mostly attitudinal questions, as you'll soon see. We explore a variety of really important demographic groups. Those include women, people of color, people who live in rural areas, military households, business owner households, and lower income households as well. So a wide variety of really important demographic groups that tend to be really on the edge in many respects when it comes to financial health and well-being. The bottom line conclusion from this data is very similar to what we reported in the past. The survey results make it abundantly clear that credit union members do view credit unions differently and much more positively than their counterparts view the institutions that they use. And that's true basically across the board in almost every metric that we look at, and certainly within the demographic groups that I just mentioned, and over time. And I'll give you some information on that in just a minute. I did want to mention, though, these differences that we're seeing stem from, we believe, credit unions' more consultative approach. They are much more likely to interact with members on a personal basis, to have deep, meaningful, and personal conversations with members, helping members get from point A to point B more quickly with a plan tailored to that specific member's situation in life at the moment. So that's super important from a financial well-being perspective and from the perspective of overall resilience. In any case, it's not just that. Obviously, our products and services matter a lot. The pricing related to those products and services matter a lot. And certainly because we do what we do and we do it so effectively and we act in members' best interests, there's a high level of trust that appears amongst credit union members is substantially higher than what we see amongst non-members. One other thing that I wanted to draw your attention to, sort of level set, as we look at the data, this is data not from our survey, but from the Federal Reserve Survey of Consumer Finances. And I think Lee talked to you about that survey a couple weeks ago. But just as a reminder, you should know that the marketplace is pretty diverse. And when we talk about credit union members, it's not like credit union members are just members of credit unions. A lot of credit union members have relationships elsewhere. In fact, almost 80%, 77% of credit union members have a relationship at some other institution outside of the credit union. It's also true that many bank customers have membership at credit unions and use credit unions as well. And so when we talk about credit union members and non-members, I just want to draw your attention to the fact that when we talk about credit union members, it's those three bars right in the middle of this construct. So it's people that use credit unions only. That's about 10% of households. Credit unions that do most of their business at credit union members that do most of their business at a credit union, and then credit union members that do most of their business at a bank, but also have some products and services at their credit union. So that's members. And then non-members would include everybody that uses a bank or similar institution, depository or a brokerage firm or that sort of thing, as well as people that don't have any banking relationship at all. You can see on the far left of this graphic, that represents a pretty small percentage of the population. So on the survey, looking at the highest level of results, this is data for everybody that responded to the survey, all 2,500 folks, and it's basically showing you over time that there are obvious points of demarcation in terms of consumer financial stress. These have been evident throughout the 3-year period that we've been doing this study. And last year, in 2023, as interest rates began to rise and in the midst of really, really high inflation, you could see a pretty significant jump in most of these measures of financial stress. More recently, in the most recent 2024 data, the purple bars, you can see that while most of these measures came down a little bit, that we can see that they're elevated relative to where they were when we started this survey back in 2022. But this gives you a general idea for the perspective that, not just members, but non-members as well, are not in a great place from a financial perspective. The stress is quite high at the moment, and it doesn't seem to be coming down as dramatically as we had hoped that it would, or as quickly as we hoped it would. So again, that's at a very high level. More high-level data that I think is an indicator of stress. This is overall, for all respondents, the percentage of folks that use alternative service providers that tend to be really, really expensive. And you can see, depending on the type of service, anywhere between roughly 1 in 10 consumers and 1 in 6 consumers use these various services according to our survey results. So again, another, I think, a very clear indication that there is stress in the marketplace and people are turning to these very expensive alternative service providers in many cases. So now when we look at credit union data and compare it to the data from people that aren't credit union members, this is really high-level overall results. And I mentioned trust earlier. You can see there's a big difference in the level of trust that credit union members have relative to non-members and the trust that they have in the institutions that they use. And again, across the board here, you see anywhere between roughly a 10 percentage point difference and a 20 percentage point difference between credit union members and non-members across these various dimensions that describe either their experiences or the viewpoint they have about the relationships with their financial providers. So really good news at a high level there. You hear me talk about financial well-being a lot, and part of the reason for that is that we view financial well-being as shorthand for the credit union mission. Credit unions were created to encourage thrift and to provide credit for productive and provident purposes, especially to those of modest means. So we've taken that stilted language that appears in the Federal Credit Union Act, written in the early part of the 20th century, almost 100 years ago, updated that language, made it a little bit more elegant, just calling it financial well-being for all. That is what we're viewing as our mission, financial well-being for all. And then we want some idea of whether or not that's being provided in the marketplace and what sort of impact credit unions are having. So on the left-hand graphic here, you can see that credit union members are way more likely than non-members to say that that their overall health is financial health is healthy. This is the percentage of people that are positive about this idea and very positive. So we have a 4-point scale: positive, very positive, negative, very negative, and there's about a 6 percentage point difference in the results on that specific issue. So I called that a really big difference, and it is a big difference, but not as big as the differences that we see elsewhere. And I should mention that result roughly aligns with the data that we see from the Financial Health Network, that organization in Chicago that tracks financial health nationally. Financial Health Network tells us they've looked at credit union members and non-members. They tell us that credit union member financial health is higher than non-member financial health, but the differences that they see are not great, just like 3 or 4 percentage points. That's borne out in this data on the far left in that first graphic. More importantly, I think, we ask credit union members and non-members whether or not their institution cares about their financial well-being and whether or not their institution has actually improved their financial well-being. And here we see substantially bigger differences between the credit union results and the results within the for-profit sector amongst consumers who are using other types of institutions. I should also mention that these are the overall results on the left-hand side of this graphic. If we just abstract from those overall results and look at the people that are very positive about these questions, so these are the high-intensity results on the right-hand side of this page, you can see the percentage point differences are not necessarily quite as big as what we see in the other data on the left, the comprehensive data. But those differences amongst people that are pretty excited about these ideas, the high-intensity results, are impactful. So we can say, using this data, the credit union members are almost 1.5 times more likely to say they're very positive that their overall financial health is healthy, that 1.5% times more likely to say that they're very positive, that their credit union cares about their financial well-being relative to what a non-member would say about the institutions they use, and 1.5 times more likely to say that the institution has actually improved their financial well-being. So these are really significant differences in the way that members view credit unions compared to non-member views. I talked about consistent results across key demographic segments. So here I'm just abstracting. I take one of those previous questions. My institution has positively impacted my financial well-being, and these are the high-intensity results associated with that. So these are the percentages of respondents that say they're very positive that their institution has positively impacted their financial well-being. And you see these really big differences, not just overall, where you see a 13 percentage point difference, but also in each one of these demographic groups. And the results vary a little bit from group to group, you can see, but consistently, the dark purple bar, that's non-member responses, is well below what we see amongst credit union members. I mentioned that the results are consistent over time. And here's an example of that. Using that same metric, my institution has positively impacted my financial well-being. Here you can see that for credit union members, the light purple bars, these results consistently year in and year out have hovered around 90%. In contrast, amongst non-members, the results generally sort of hover around 80%. So pretty big difference in the results overall, and again, consistent over time. one of the reasons we think that these results appear are, as I think I mentioned earlier, credit unions really do approach their relationship with members in a very consultative way. We know that nearly 90% of credit unions offer personalized services around financial well-being. They offer members to talk with them about where they're at and where they want to go. And we know there's a lot of research around this topic that those conversations truly are impactful. We also know that financial education, putting pamphlets in your lobby, is not terribly effective. It's those conversations, ongoing conversations with people that make the most difference. And the key here is ongoing. When I talk about financial well-being, you have to recognize that I'm not thinking about that in terms of a state of being that is long-lasting necessarily. People fall in and out of financial well-being, and because of that, they need to have those touch points on an ongoing basis. But we know from a variety of academic research that those conversations really are the game changers in the consumer sector. And here we can see that credit union members are almost 1.5 times more likely to say that they've used a personal education or counseling service at their institution. So they're much more likely to engage in those behaviors. That's the light bar on the left. And then because of those conversations, they're much more likely to engage in behaviors that produce financial well-being, that produce resilience, and that help people avoid disruptions in their lives. That shows up on the right-hand side of this graphic, which is the percentage of folks that say that they have not put $500 aside in a rainy day fund. And you see that credit union members are much less likely to say that they don't have that buffer. Credit union non-members, 36% of them say, no, I don't have that. So non-members are 1.25 times more likely to say that they have that financial weakness. And because of that, by extension, they are less likely to be resilient. They are more likely to be disrupted. When we talk to our partners at the Financial Health Network, and I asked, I think I've probably mentioned this on several videos in the past, I've asked them, you have a rubric, and it consists of spending, saving, borrowing, and planning. And each one of those 4 concepts has 2 questions in your rubric associated with it. So there's 8 total questions that lead to an evaluation of an individual's financial well-being. And my question to them was, of the 8, what are the 2 most important? These are the 2 most important: planning for unforeseen events and having some money set aside to help you navigate those unforeseen events. So these are consistent with results that we've seen in prior years and very, very important from the standpoint of financial resilience and financial well-being. Credit union members generally see credit unions, and this shouldn't surprise you at all, but they generally see their credit union as really leading in the lending arena with consumer-friendly rates and obvious terms. Credit unions have a history of being careful lenders, of not saddling consumers with loans that are inappropriate just to make a buck. Here I'm thinking back to the build-up of the housing bubble in 2004 to 2007, where in the for-profit sector that was happening, and it was happening a lot. Recall that in 2003 or thereabouts, for-profit institutions, banks, and mortgage companies were originating about 5% of their loans to subprime borrowers. By 2007, that 5% portfolio share went to 25%. Many people that could not afford home mortgages were not only saddled with home mortgages, but saddled with inappropriate home mortgages they couldn't afford. That was very, very clear. Of course, the for-profit institutions had an originate to sell model, so the problems on the back end became somebody else's. They weren't the problems of the originators. So that was kind of what was going on there. Didn't happen in credit union land. We see the same sort of thing happening at the moment, parenthetically here, in the automobile arena, where we see both banks at auto finance companies, originating large percentages of automobile loans to deep subprime borrowers and subprime borrowers, near prime borrowers across the board, and at rates that are quite high, in excess of 30% overall in many cases. I think the median amongst deep subprime borrowers is a rate of about 25% or maybe a little bit more than that. So these are really expensive loans, and most households can't afford those expenses, especially during tough times as the economy weakens and people get into situations where they're more likely to be disrupted from a jobs perspective. So in any case, credit union members, so these are the other two components, spending and borrowing. You can see not a big difference on the spending front. I'll probably need to come up with a different question on spending, but this is the closest thing that we have in the series that I presented the researchers. Do these institutions make it easy to manage your money? There's not much of a difference when we look at the overall results there. 92% of credit union members are positive or very positive that that's the case. 90% of non-members are positive or very positive. So again, not much of a difference. But here you can see on the lending side of the equation, really, really big differences. It's easy to get a loan, and the institutions, credit unions, provide low-cost loans. You can see this at a much higher rate. 90% of members say they can get low-cost loans. Only 69% of non-members say that. Really, really important concept, especially in the current rate environment where, interest rates have gone up from basically 0 to 5.25% on the short end of the curve. Credit is expensive. And this is all, of course, wrapped into financial well-being because home ownership is one of the big drivers of wealth in the United States and in intergenerational transfers of wealth, on the one hand. On the other hand, automobile lending, access to a reliable, affordable car is really important for people that need to get to a job, that need to get their kids to school, that need to get their elderly parents to and from doctor's appointments. Very, very important for overall well-being, not just financial well-being. And the fact that interest rates have come up so much recently has made a lot of that, a lot of those loans unaffordable for many people. In general, consumers are much more likely to find an affordable loan at a credit union. This data shows up in the Equifax data that I talk about at every opportunity. We have access to the Equifax analytic data set. We've explored it in fine detail, and I've probably told you this before, but the most recent data that I looked at amongst credit union members, the savings for a home loan, 30-year fixed rate average loan, comes in at about $55,000 over the life of the loan. If we look at a typical car loan, credit union members that use credit unions to finance are saving in excess of $10,000 over the life of a 6-year car loan. So these results really do align with the data that we're seeing in the Equifax database. Credit unions are a better deal, are not for profit. Member ownership matters a lot. Not having stockholders demanding a market rate of return on investment obviously means that we can take the profits that would go to outside investors and deliver those savings to our members in the form of lower interest rates on loans or higher interest rates on savings in the current environment. You can see here too really strong results when we look at the high intensity, the fourth point on that 4-point scale, the people that say they're very positive these things are true. Credit union members, 2.2 times more likely than non-members to say it's easy to get a loan at their institution, their credit union, and over 2.5 times more likely to say that they can get an affordable loan. So really, really important in the current environment against the backdrop of really high interest rates and a lack of affordability, both in the housing sector and in the automobile sector, where we see pretty significant dislocations. So very, very important. So that's a quick line of sight into the data that we've just collected I received it as I was boarding the plane to come out to GAC, so have not shared it widely up to this point. It's fresh off the press. And I think you'll find that it can serve as a springboard for your advocacy efforts, your interactions with policymakers, because it really does drive home the point that there is a credit union difference and that credit union members are better off financially. They're going to be more resilient than non-members for a whole variety of reasons. The mission focus is there, and the impact of that mission and focus on mission also is obvious in the data. So that's it from frigid Madison, Wisconsin. I hope you join us again next month for the April edition of our economic update. Hope to see you then.